Hello and welcome to The Pitch. I'm Sarah Allen and today I'm joined by Gleeson from Betashares. We're going to take a closer look at how geared ETFs work and how you can use them in your portfolio. Cameron, welcome.
Thank you, Sarah.
To begin with, you've recently launched 2 new geared ETFs. Can you give us a quick overview of each?
These wealth builder funds are designed to provide investors exposure to a diversified portfolio of Australian and global shares, but using a moderate degree of leverage, which can accelerate your wealth creation over the long term. The funds are internally leveraged, which means that the borrowing is managed by Betashares and wrapped up in the fund. The funds have a loan to value ratio, or LVR, of between 30 and 40%, which means that generally speaking, their funds will give you an exposure of around about 1.5 times the movements in the daily underlying portfolio. So the two funds are G200, which is exposure to the largest 200 Australian listed companies. And then we've got GHHF, which is a diversified portfolio of around about 4,000 Australian shares and global shares. So great sort of diversified solutions. And I think if you're going to use a geared solution, diversification is one of the keys to reducing that sort of risk.
And these are both geared versions of your existing strategies too.
Yeah, that's right. So GHHF, if you think about the genesis of that fund, is really based on a very popular DHHF product, which is that all-in-one growth solution, both Australian and global equities. A200 is a very popular fund of ours. It's our Australian equity flagship fund, and G200 is really based off that fund, just providing that geared exposure to the same portfolio of stocks.
So these funds are called wealth builder funds. Would you use them more as growth or income or both?
Look, both funds are going to give you a combination of capital growth and income, and they're designed to do such. Really depends on your circumstances and how you're thinking about building your portfolio. Whether or not you choose to, for example, turn on the dividend distribution reinvestment plan to allow it to capitalise, or take income out as you go.
And what are the risks of using these types of strategies?
So, there's obviously the key risk with any sort of geared product is that gearing will generally increase the volatility, therefore the riskiness of your portfolio. You're going to see larger magnified gains and losses both up and down. So that's a clear risk there. A second point to note is that each day, if you were to look at the websites, you'll be able to see the current geared exposure of these funds. In other words, what is the relationship between the underlying portfolio and the return for the fund on that day? But over the long term, returns of the fund can also be impacted by compounding, by rebalances, and by interest costs in the fund fee. So that's another thing to take into account. And then sort of more broadly, the other, I guess, if you like, risk or thing to be aware of is that just because the market goes up, it doesn't necessarily mean that a geared fund will outperform an ungeared fund. In order for that geared exposure to outperform, you need the capital gains and income that it produces to eclipse the interest cost with regards to that geared exposure. So a few key things to look out for there and certainly be aware of when you're looking to use any sort of geared product, really.
I'm going to revisit a point you made earlier about dividends. Can you get dividends and franking credits from using geared funds?
Yes, you can. So within this suite, we've got 2 funds, both of which hold Australian equity. So in either case, you're going to receive dividends because they are equity funds and they hold underlying shares in terms of that end exposure. But both G200 and GHHF hold at least a portion of Australian equities, and so as a result, the fund itself will collect dividend income or derive dividend income, and then it will pass through fund distributions to the unit holders of the ETF, and where franking credits have come through from an Australian share, that will then be attached to the distributions of the fund. And as a unit holder in the ETF, when you get your distribution or tax statement at the end of July, that'll actually show you the amount of franking credits attached to those distributions for the tax year.
So traditionally, geared products are seen as more of a short-term solution. You might be watching it for the minute or maybe even a few weeks. It's not always the case with the new geared funds that you're offering. Why is that? What's the traditional life cycle you would say for these funds?
Yeah, so if we think about more traditionally geared products, often they have a very high degree of leverage. I think the secret with these funds is having that more moderate amount of leverage allows investors to ride out the downturns in a way which is much obviously less volatile. And that's kind of the key of taking advantage of the market's compounding power by using gearing, is if you can ride out the lows. So if I'm an investor with a very long time horizon, and if I have a reasonable degree of risk tolerance, I can use this fund and allocate to it over many years to build my capital base before I perhaps come more risk averse and start deleveraging or adding in ungeared exposures into my portfolio. So it's really about building up that wealth base, when you have a long investment time horizon and taking advantage of that compounding power of the market.
So you could view it as a buy and hold strategy.
I absolutely think that this is for many investors who have that degree of risk tolerance, they can think of this as a set and forget strategy where they continue to invest, constantly investing in the market. That's how you compound your wealth over time, and using that bit of leverage just accelerates that growth in capital as the market rises over time.
How can investors use these strategies as part of their overall portfolio?
Yes, I think there's a number of really great ways that these can provide a solution for people. For example, if we take an investor with like a low capital balance to start with, looking to take advantage of the market's compounding power, using a dollar cost average approach, perhaps to really grow their capital, because gearing allows you to have more exposure to the market from the day one of your investment period. And then you've got SMSF investors who might, for example, be constrained by the superannuation concession caps. So using gearing can allow you to take more exposure within your SMSF, or indeed increase or enhance the amount of franking credits you can generate within that really tax efficient structure. Or finally, investors who are looking to be more capital efficient with their investment, or indeed manage cash flows. So for example, if I want to retain exposure to the stock market, but I also want to pay down my non-deductible debt, like my mortgage on my house, this might be a way that I can do that.
Thank you so much for sharing your insights today, Cameron. If you've enjoyed this interview, please subscribe to Livewire Markets. Thank you for watching.